talk about today on this live, and I'm glad you're with me tuning in here, whether you're here live when we're broadcasting it, or if you are joining us after the stream. I'm glad you're here. Let me know that you're here in the chat. It's good to see a bunch of people hopping in here already. Today we're going to talk about the Bank of Canada and what the trajectory for the Canadian economy looks like as of today. We recently got the monetary policy report from the Bank of Canada, and just last week, I believe on February 17th, the Bank of Canada's governor, Tiff Macklem, and the deputy governor, Carolyn Rogers, gave testimony in front of the Federal Finance Committee. This is something that they regularly do, come to the Finance Committee and answer their economic questions. Now, sometimes politicians take this as an opportunity to sort of gather points that they can use to throw at the opposition, whoever they're against in the House of Commons. Sometimes we actually get some accurate and some insightful comments as well. See people hopping in here in the chat. Let me know that you're here, and I should be able to hear some people hopping in and getting in here, so it's good to see folks doing that. We've got Kyle and Light and Perry and Let's Go Gaming. It's good to see you. Jasbina, great to see you. I'm going to give a moment here just for more folks to tune in as we get started here talking about the Bank of Canada. The recent inflation data, that was a shocker to many, right? We were surprised to see what inflation data we saw today, and where that makes it look like the economy is going. Is the Bank of Canada done raising rates, or are they likely going to keep it steady Eddie and go on their March break leading into this new month? I'm seeing more folks tuning in here. Dismilla, 006, Chance, Tony, good to see you. Let's hop into the content right away. First of all, I want to take a look and show you sort of where inflation is right now, because we just got new data as of yesterday. Let's go over here to the stream on the browser view, and you should be able to see this okay. Maybe I'll even move this over on the stream just for a moment here so you can see where we're at today. This shows a whole bunch of different inflation data, and we're going to take a look at this before we go into the Bank of Canada's testimony at the Finance Committee meeting. Good to see folks tuning in here. So we've got a new number for the total CPI, this blue one, the 5.9 here. That's where inflation came in recently, lower than expectation after we got a 6.3 print back in December of 2022. The January numbers came in at 5.9, largely due to some of the more volatile elements coming down in price, right? We see the energy prices coming down a little bit here, and that's something that sort of contributed to this. And we can see the total CPI getting closer to that CPI trim number, which is the entire CPI, but trimming out some of the most volatile elements, including energy, and also, I believe, including food prices, if I'm not mistaken. So that's interesting to see. Now, this information wasn't available at the time of what we're going to take a look at now, which is the appearance of Tiff Macklem and Carolyn Rogers at the Finance Committee just as of last week. We're going to take a look at this. I'm going to pause and provide some context as we go along the way. And yes, if you're here live with me, and I love to see so many folks tuning in, drop a comment, and you'll see yourself in the chat here. And you might know that we're heading into a little bit of a new format on the channel here. We're testing it out, where we'll take clips from this live stream and make the main channel content from those clips. So you might even see yourself in one of the sort of more formatted videos as well, with your name in there in the chat. So, and let me know what you think about this all along the way, because I'm going to be looking at the chat and responding to some questions here. But let's dig in and get the opening remarks from Tiff Macklem and Carolyn Rogers here in front of the Finance Committee just as of February 17th, just at the end of last week. I believe it was Thursday, if I'm not wrong.
And Rogers, welcome. So for your opening statement, remarks, and the members then will look forward to asking you questions. Please.
Well, thank you, Chair, and good morning, committee members. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our recent policy decision and our monetary policy report. In January, we raised our policy interest rate by 25 basis points to 4.5%. We also said that we expect to hold the policy rate at the current level while we assess the impact of 8 consecutive interest rate increases since March of 2022. This is a conditional pause. It's conditional on economic developments evolving broadly in line with our forecast. Since the last time we were with you, we've seen some evidence that our interest rate increases are starting to slow demand and rebalance our overheated economy. With inflation above 6%, we're still a long way from our 2% target. But inflation is turning the corner. Monetary policy is working. Avant de passer...
Okay, so some interesting notes there to start from Tiff Macklem. They said, hey, we are pausing. This is our short-term pause here. We want to make sure that the incredible rate that we've been raising interest rates isn't going to have an extreme effect on the economy. We think that it's going to trickle into the economy over time, and that the interest rate sensitive industries like real estate have already been heavily impacted, and it's a matter of time before we see that in other areas of the economy. Again, noting that this is a temporary pause, and if they see enough data saying, hey, you need to keep on going, keep on raising rates here, well, they're going to do so. This is the language that the Bank of Canada governor has continually used, saying this is a conditional pause. Inflation is our main concern. It is going to come down, and we will attack it with more interest rate increases if we see evidence of inflation remaining high or even increasing again. So that's interesting to hear from Tiff Macklem.
Before we take your questions, I'd like to outline the impact on our rate increases have had so far. I'll explain what we expect to see this year. Finally, I will highlight some of the risks that we take, and the inflation continues to come down and return to our targets. Inflation in Canada has eased but remains high. Annual consumption prices, CPI, inflation moderated at 6.3 in December and peaked out at 8.1 in June. So far, the easing mostly reflects lower prices of energy, particularly gasoline, with global supply chains improving and demand slowing here at home for big-ticket items that people often buy on credit. Prices increases for these durable goods have also moderated. Prices for food and many other services continued, however, to rise much too quickly. The Canadian economy remains overheated and clearly in excess demand, and this continues to put upward pressure on many domestic prices. A broad range of labor market indicators have also shown only moderate signs of easing.
Another important thing to note here, right? They're talking about how we're seeing that there is still excess demand in the economy. One of the key things that he said there also was that there is still excess labor market tightness, right? There's not slack in the labor market. We're still seeing more wage increases than we would expect to see. It's still easier or harder to hire people, easier to get a job than we would expect it to be at this point. So they're expecting that to come down. They were sort of shocked by the jobs numbers last month when we saw that they were far higher than expected, right? That you'd think that if you raise interest rates significantly, that the jobs numbers would go down as a result of that. That's kind of what they're banking on, right? They need to make sure there's less demand in the market so that businesses can't pass on expenses as quickly to consumers for fear that they'll go to a competitor, right? When demand is sky high, businesses can crank up their prices far more quickly. This is what the Bank of Canada governor has sort of been saying for the past month or so. That's interesting to hear. We're going to flip to 108 here. I have some notes from the first time I watched this through, and let's get into it.
Could remain elevated in Canada, or increases in labor costs could persist. Overall, we view the risks around our inflation forecast as balanced, but with inflation still well above our target, we continue to be more concerned about upside risks. I want to leave you with a few key messages. The decline in inflation since the summer is welcome relief for many Canadians who are struggling to keep up with the rising cost of living. But at more than 6%, inflation remains too high. To fight inflation, the Bank of Canada responded forcefully, raising our policy interest rate from 0.25% a year ago to 4.5% today. That is working to reduce demand and rebalance the economy. We're still a long way from our inflation target, but recent developments have reinforced our confidence that inflation is coming down. And we are committed to getting inflation all the way back to the 2% target so Canadians can once again count on low, stable, and predictable inflation and sustainable economic growth. And with that overview, the Senior Deputy Governor and I would be pleased to take your questions. Thank you.
Well, thank you, Governor Mac.
So some interesting opening statements there. We talked about most of the main points here. Of course, obviously putting forward that message that, hey, this is working. We're doing our job here. Of course, because expectations have a big impact on where the economy goes and where inflation goes, right? That's one of the key tools that the Bank of Canada has, is their language that they use to talk to the Canadian consumer. Now, we're going to hop around here and get some takes on this initial statement, and then we're going to go back into questions that were sort of asked inside of this committee meeting by the individual politicians. We have a take here from BNM Bloomberg that we're starting to see disinflationary trends, not deflationary, but disinflationary, referring to a slowing down of inflation, like a trend on the slower side, like lower numbers than we've seen in the past for inflation, but not deflation where we're like below zero. This is the BNM Bloomberg's take. I'm listening to this one fresh, so I wonder what we're going to get here.
We have breaking economic news. Inflation numbers for January have just been released. They have come in lower than expected. Annualized inflation in January ran at 5.9%, according to Statistics Canada. That release just hit the screen moments ago. As we told you earlier, economists had forecast an increase in January inflation on an annualized basis of 6.1%. So where 6.1% was expected, 5.9% has just been reported, a lower number than expected. It's also meaningfully lower than the 6.3% reported in January. A slightly different picture when we look at core inflation, which excludes the impact of volatile fuel prices and food prices. That number comes in at 5.00% as CPI core median. There are two different versions of core inflation, median and trim. Both of those numbers, the median number comes in slightly stronger than the 4.9% that was expected. The core number comes in slightly weaker than the 5.2% that was expected at 5.1. Let's bring in an expert for analysis. Dominique Lapointe is global macro strategist at Manulife Asset Management. Dominique, thank you very much for joining us. The big question is, does this give the Bank of Canada room to pause on interest rates, not to raise rates the next time it makes a policy announcement?
Definitely, because the data that we've received, not just in Canada, but globally over the past 2 weeks, suggested two things: stronger and more resilient growth at the start of the year, which would feed into more sticky than we'd want inflation data early in the year, and that led many observers to think that we need more rate hikes and leave those rate hikes for longer. So in contrast to the United States inflation data we've had last week, the Canadian data is showing clearly, surprisingly, more disinflationary trend at the beginning of this year, and that for sure that will comfort the Bank of Canada going into the March decision.
We have also received just minutes ago new retail sales numbers in Canada. And the big takeaway here is that appears to be that retail sales, when you exclude automobiles, which of course are big ticket items that can skew the numbers one way or another. So leaving aside automobile purchases, retail sales fell by 0.6% in December. This is a December number, not a January number. The value of all retail sales, excluding automobiles, fell by 0.6% in December. That is a much steeper decline than the 0.1% that economists had expected.
That's a big deal for those who don't understand exactly why that's such a big deal. The Bank of Canada, this is like candy for the Bank of Canada. They're like, thank God we're getting some numbers that show the economy doing more poorly, right? It kind of seems like we're in this backwards land, right? We've talked about this before, where, well, the Bank of Canada doesn't want the economy to do well right now. It doesn't want to see this sustained growth in the Canadian economy. It doesn't want to see job numbers going up. And it certainly doesn't want to see retail sales numbers going up because right now it's saying we are in an area where we have excess demand. We want there to be more supply so we can get to a balance so the output gap comes closer together. And that's what these numbers suggest, right? If we were previously in a period where there was so much demand that prices went up drastically and businesses were able to raise prices extremely quickly, well, now when we're seeing that retail sales numbers are down, that means that, okay, maybe what we're doing with the interest rates is actually working here. Maybe it's going to slow down the amount of things that people buy. Retail sales numbers go down. And as a result, we get inflation down over the long term. That's what they're talking about here.
Same question. Do those retail sales numbers fit into the disinflationary picture that you've just talked about?
Yes, and it's also, the fact that consumption is slowing on the retail side is actually a positive development.
Exactly what we were just talking about.
We start to see slower goods consumption in Canada in the third quarter, and what the data confirms today is that that slowing momentum carried through Q4. Now, I want to point out also that when you look at retail sales consumption on a nominal basis, we are miles away from the pre-COVID trend. So it's expected and normal that the pace of that there's a contraction into the amount of goods that households in Canada consume as the effect of interest rates unfortunately hurt some of their pockets.
Help us understand these core inflation numbers. First of all, as an economist, which one do you pay most attention to, median core or trim core?
So we have a lot of core inflation data in Canada, unlike the US where they only have one, which is excluding food and energy. The one we pay attention to the most is the one that the Bank of Canada tells us that they pay attention to, which is both CPI trim and CPI median. There used to be CPI common, but they are revising the methodology so far. So we're looking at these two. And it's important to point out this morning that going into the release, we were expecting some upward revisions because Statistics Canada told us that they would revise the seasonal factors going back. So it's not a surprise that we do get some upward revisions into CPI median, especially. But the fact that it slowed down by quite a bit in January is encouraging because our opinion, looking at the US data, was that these measures would be revised up and stay flat. So again, this is a positive development this morning also on these core measures.
Again,
Yeah, I see some chat here in the comments. Basematic says the whole purpose of this meeting is to manipulate the financial industry. And essentially that's what central bankers are tasked with, right? Their whole job is to manipulate the economy with the goal of having inflation between the 1% to 3% sort of range. That's their stated goal, like what they're trying to do. So of course, any meeting is supposed to sort of bring us closer back to that goal, including like having more financial stability as a result of that lower inflation. That's their goal. They say that they're going to hit 3% by the summer of this year and 2% by 2024, sometime in 2024. Now, I don't know if people believe that is fully going to happen. Of course, we're comparing to last year's numbers where the prices were already quite high. So it does seem a little bit more plausible that they're going to get it back down to target. But I agree with you, Basematic. The whole purpose of the meeting is to manipulate all the entire economy, not just the financial industry.
For viewers, the headline inflation number has come in significantly lower than economists had forecast. That number is 5.9%. The annualized pace of inflation in January, from January of 2022 to the end of January 2023, economists had forecast 6.1%. So it's 20 basis points weaker than the economists forecast. It's also 40 basis points less than the 6.3%. That was the December figure. So the question is, Dominique, can inflation track downward as rapidly as the Bank of Canada wants it to by the second half, by the end of this year, let's say?
It's not that rapid as a decline. They don't expect inflation to go back to 2% until, I think, middle of next year. What we do see, though, is in the near term, the base effect, so the fact that commodity prices have rolled down, and that feeds through a lot of inputs for businesses. What we do see is some disinflationary pressure until at least the beginning of the summer. And then the question is, what happens then? Will there be an inflection point where those this inflationary pressure that just comes from the data sort of slows down, and are we going to see a pickup in inflation towards the middle of this year? And that is the upside risk to the scenario. If the economy doesn't slow down as much as central banks think, and we end up in a situation where core CPI refuses to slow down this summer, and then central banks preemptively could want to raise rates by a lot more. And then we could go into a situation where there might be a chance of a softish landing to somewhat of a harder landing, but we would only see that coming through at the end of the year because of the delay for which interest rates actually impact the economy. So that's the risk.
So let's go back to.
And ultimately, that's the Bank of Canada's big fear, right? That's their worst case scenario, right? That they haven't raised interest rates far enough, and we get some sort of double dip recession here, where they raise rates as much as they think they need to, and then they sort of pause like they are now, and then they realize that inflation goes back up, and then they have to hit the interest rates even harder and for even longer to make sure it's dead, right? Paul Volckering is like the verb because of what happened in the States during that central banker's era, really needing to kill the economy to kill inflation, right? That's the Bank of Canada's big fear, is that they're not going to go far enough, and then they won't be able to keep inflation under control. As a result, people's inflation expectations aren't under control. They think that the prices are going to rise over the long term, so they go out and spend more money today because things are going to be more expensive tomorrow. That causes more inflation, right? The Bank of Canada's entire credibility lies on them getting this back to the 1% to 3% range. So I don't think that they're going to stop at anything. But it is interesting to note that the Federal Reserve in the States is still on the hiking path, right? We recently saw that most of the members who make the decision about the rates within the Federal Reserve said that, hey, yeah, we agree on a 0.25% hike. Something that the Bank of Canada said, hey, we're good. We're going to pause, sort of being the trendsetter here for once, which is rather interesting. Another video I wanted to show you here is a positive take here, that there's reason to be a little bit optimistic about interest rates. And after this, we're going to go back to the Bank of Canada, the sort of testimony that it's given with the Finance Committee in the House of Commons. Like FINA is the sort of abbreviation for that committee. We're going to take a look at the questions, what the Conservatives ask of the Bank of Canada, talking about the bank debt that they have now. The Bank of Canada is now sort of out of money, and they're actually going into debt, quote unquote debt. It's a little bit different when it's a central bank doing it, but we'll get into that in a minute.
Things to discuss this morning. We've got the broader cautiousness that we are seeing in North American trading, and then we have the latest read on inflation in this country. And it's interesting, you've got messaging that seems to suggest central banks in Canada and the U.S. are for now on slightly different paths. Let's bring in Christine Tan. She's a portfolio manager with SLGI Asset Management. It's nice to see you.
Good morning. Good to see you.
We can talk about the U.S. markets in just a second, but the big story here in Canada this morning was an inflation print where prices are showing some signs of softening. Yeah, I know. We got to, yes, exactly.
Exactly.
And there seemed to be a takeaway because we saw the Canadian dollar a little weaker that maybe the Bank of Canada is justified for now in staying with this, okay, we're going to wait, see how things play out,
right, and
stick with hold mode for now. What was your takeaway on the inflation numbers?
I think you characterized it perfectly. Okay. This morning's print probably gave Macklem a big sigh of relief, because on January 25th, he came out, hiked 25 basis points, and it was pretty clear. He said, we're on pause for now. But then we had a really big jobs number.
That's a great point, yeah.
So he was probably on edge thinking, well, are we going to be forced to act? So today, it's just a titch softer than expectations, 5.9. But if you delve into the details, so our team really thinks it's important to look at the details at this point in the cycle. So things that are fading continue to fade. And the three components that are still adding a bit of pressure to the upside is shelter, and we know why that is, because mortgage costs have gone up.
Right.
And food, again, we know that's something we feel every day when we go shopping. And gasoline, but that's moderating a little bit as well compared to the worst levels of last year. So even looking into the details, there's reason to at least be a little bit optimistic, but again, data dependent. You have to continue to do what the Fed is, or what the Fed and the Bank of Canada is doing.
Well, to your point about housing, I mean, if your rent is up or
Yes.
if your mortgage costs are up, a lot of this ties back to the fact that interest rates have been rising at such a rapid clip. And Macklem himself has already talked about that reality, the level of debt Canadians hold, and the weakness we've seen in the housing market as arguments for actually being in pause mode now, because we just don't know what's going to happen on that front.
Yeah, that's interesting to talk about, right? Because we talk about what happens when the Bank of Canada so aggressively raises interest rates. Of course, this is going to impact business spending and the amount of new businesses able to take out more money, like take out larger loans to finance the expansion of their businesses. And as a result, that will weaken the economy. But I think one of the main sort of ways that the Bank of Canada can impact the pulse of Canadians, the decisions that Canadians make, is through their manipulation of the housing market, right? There's a real wealth effect when the interest rates are low, like they were during the pandemic, to stimulate the economy. This is what the Bank of Canada was doing, manipulating the economy to try to stimulate it when everyone was staying home. When interest rates were so low and house prices were going up dramatically, well, homeowners, they feel comfortable. I've got this equity bubble. I bought this property and now it's worth such and such amount more. They're going to feel more wealthy, even if it's not a realized gain. They're going to feel more wealthy. They're going to spend more money. They're going to go out to businesses, pay for more services, pay for more goods. This is exactly what heated up the economy. And now we're seeing the exact inverse happen on the downside, right? The Bank of Canada hikes up interest rates at the fastest rate that they have in recent memory. And as a result, home prices immediately come down rather significantly, one of the largest corrections, again, in recent memory. I'm not going to tie it to exact dates because I'm not an encyclopedia of dates here, but yeah, you're seeing the opposite effect, the negative wealth effect. People who bought homes at the top are underwater on their mortgages. They're completely strapped for cash, right? We saw the reports of every Canadian, or most Canadians, are no less than or no more than $500 away from insolvency, right? If they had an emergency, they wouldn't be able to pay that bill. As a result, people aren't going out and spending money anymore. So this is the way that the Bank of Canada and the way that they impact interest rates has a sort of a chokehold on how Canadians spend. That's exactly what they want. People to feel less wealthy, people to spend less, there to be less demand, as a result, less inflation, and then maybe they can start thinking about bringing rates back down and changing things the other way.
Exactly it. You know, if you look at the rate sensitivity of the Canadian market, the fact that our mortgages are so much shorter, and we have a lot more adjustable rate mortgages too. Like this morning, they were saying in the U.S., 91% of mortgages are fixed.
Lock it in for 30 years.
Exactly.
Or whatever. Yeah.
So the rate sensitivity, which is what makes it a bit more challenging for the Fed, we don't have that here in Canada. So it really does speak to Macklem taking a prudent approach of waiting and seeing.
Now, going back to the U.S. story, and there's a few moving parts this morning. You had a couple of big retailers like Home Depot and Walmart with softness, and so that influences the trade. But there does seem to be this view that central bank can continue to raise interest rates. You mentioned the differences on the housing side, but you also talked about a strong jobs report here. I mean, we have continued to see pretty resilient, outside of Walmart and Home Depot's forecasts, resilient consumer activity in the U.S., which seems to make it complicated for the Fed.
Absolutely.
Yeah.
Even in Canada, our retail sales is, wouldn't say quite as resilient, but it is holding in, right? Because as long as people are employed, as long as they feel like they can find a job if they want it, and unemployment rate is still at a multi-year low at around 5% in Canada. So it does speak to an economy that's maybe not as tight as it was, but it's certainly not a whole lot of spare capacity in it at the moment.
So I know a lot of people feel more cash-strapped these days. I know there is uncertainty out there. We don't know how these interest rate hikes are ultimately going to impact the economy in 6 or 8 months. But the conversation seems fairly balanced on, interest rates moving to more normalized levels, an economy that's hanging in there, some signs of inflation easing. So as a professional investor, what do you do against that backdrop?
It's tough because we know there's a slowdown coming, maybe not an outright recession, but the timing is the tricky part. And certainly both Canada and the U.S., is proving to be a bit more resilient. So what we're doing is on the equity side, we're very cautious, quite defensive. We like dividend payers where we can own it. And then even companies, you can own discretionary, you can own industrials, just make sure they're companies that have a more defensive quality to the business. And then we like bonds.
And bond.
And with yields where they are,
Who doesn't like bonds these days with the high yields, right? Like most people like that. I think that's why a lot of growth stocks, crypto included, I sort of lump that into the same category. Why all of that is not doing as well as it was during the low interest rate period. When you have a higher risk-free rate, right? You can just put your money in a bond and get 3 to 4%. Well, then maybe you don't need to go as far down the risk curve to get the returns that you're actually looking for. So that's an interesting topic to talk about. I want to now flip back to the Finance Committee hearing with the Governor of the Bank of Canada here. Some interesting questions were asked here. Some that kind of pissed me off. I'm going to be frank. Some of the ways that certain politicians asked certain questions of the Bank of Canada Governor. Again, I try to stay pretty unbiased here, but I'm going to call out bullshit when I see it. And I think that there is a little bit in this committee meeting, and we're going to hop around, but let's start listening in, and I'll find a spot that we can hop to that has the most interesting and most juicy stuff.
Eklund, for those opening remarks. I know members are eager to ask many questions. In our first round, each party will have equal time, that is 6 minutes, and we're starting with the Conservatives. MP Hallen for 6 minutes, please.
Thank you, Chair. Thank you, Governor and Deputy Governor, for being here today. Governor, in January's monetary report, you indicated upward pressures on prices stems from problems such as labor and difficulty sourcing goods, such as building material or food, as you've highlighted today as well. Would canceling domestic policies such as the carbon tax, the escalator tax on excise duties, and the luxury tax, which all have a negative impact on production, as we know, help to ease those supply issues?
Well, on supply issues, I guess I could say a few things. The supply issues that have affected particularly goods prices, many of those are global in nature, and they have certainly been more intense and more persistent than we had expected. But I am pleased to report they are working their way out. You can actually see in the Monetary Policy Report there are a number of graphs that show shipping costs, delivery times, and they're looking maybe not quite normal yet, but much more normal than they've looked for some time. And the other aspect of that is we've seen the demand for goods has, largely with the increases in interest rates, demand for goods, many of which, especially larger goods, things like houses, furniture, appliances, people often buy those on credit, and so those are some of the first places you see higher interest rates feeding through the economy. And so they've been slowing, so with slower demand and better supply, you actually have seen goods prices roll over. With respect to your specific questions about taxes, carbon taxes, those are built into our projection. They have effects. Those are built into our projection.
So then would you agree that eliminating those domestic policies, like the carbon tax, would that help to bring down the inflation?
The carbon tax, so the increases in the carbon tax that have been announced are adding about 0.1% to inflation in each year of our forecast.
But we know it's still adding to it. Would you agree that eliminating those domestic policies, including the excise tax, that would help you to fight inflation?
If the carbon tax was not increased, our estimates are that inflation in our forecast would be 0.1% lower in each year.
It would be lower. Thank you.
So that's the thing that I got frustrated with. Can you guess why I'm frustrated with that? Jasrat Singh here is the finance critic for the Conservative government, and I feel like this question wasn't actually to try to get any insight from the Governor of the Bank of Canada or get any clarification on understanding things. I feel like that question was kind of trying to bait so that he would have something in question period to sort of throw back at the Liberal government and say, even the Bank of Canada governor agrees that the carbon tax is a bad idea. Now, regardless of whether or not you like the carbon tax or not, you think it's a good idea or not, I think it's frustrating when you see this sort kind of gotcha type question where it's like clear that he just wants to get the little soundbite of the Bank of Canada governor saying the carbon tax is inflationary so that he can go then like spit that back at the Liberal government. Now, I personally don't think that the carbon tax has been effective in general as an economic policy, one, and two, as a climate policy, because when you look at Canada's performance against all of the other countries that are sort of tracked in terms of these climate goals, you can see that Canada is drastically lagging behind. We haven't hit a single climate goal, so clearly there's something in this system that isn't working, right? Clearly something is messed up. Like if we're using this carbon tax system and we're not hitting our goals, then maybe the carbon tax system needs to be altered. Maybe there's a better way to implement a carbon tax. Maybe it's not the right policy at all, and there should be more of a focus, like Polyev says, on developing technology that can help us reach these carbon goal or climate goals, as opposed to the carbon tax. I don't know what the answer is, but this kind of like gotcha question is something that really pisses me off, and I don't know if you guys feel the same way, but it's like you're not asking a question of the governor. You're not trying to get any insight. You're not trying to enlighten Canadians about some detail that you think they don't understand. You're looking for ammo, and that kind of frustrates me. And this is where I think these live streams, you guys get a little bit of a deeper view on some of my thoughts on these things because I have the opportunity to expand. I'm seeing some people agree. Yeah. Exactly. He's trying to point out an obvious issue. I agree, but yeah, you're right. You're right, Mata Tat Tat. I agree, but to be fair, he didn't answer his question directly. Yeah, he didn't until the end there, right? But I think that he gets the sense that he's being used for these partisan types of games. He's trying to avoid that, and that's why he didn't just say yes. It wouldn't be inflation. It would be inflationary because that's the answer. Yes. The carbon tax adds to inflation. He was very clear not to say it in that way, and he was saying if there weren't the carbon tax increases that are planned, inflation would be 0.1% lower, like being very clear of the amount so that he can't take it out of context. So I found that one pretty interesting. Yeah, Brian, this is still live. You're still here live with us.
And do you still believe, and like you said once before, that inflation in Canada reflects what's happening in Canada today?
Yes, I think the initial run-up inflation was mostly driven by global factors, much higher energy prices. As I just talked about, global supply chains were really gummed up. We see a big surge in demand globally for goods, and all that drove goods price inflation up very rapidly. But about the beginning of last year, so this time last year, service price inflation was actually still about 2% in Canada, but over the course of the year of last year, it rose very quickly, and that largely reflected what's happening here in Canada. The economy overheated. The economy, once we got through Omicron, last year this time we were just coming out of Omicron, and the economy's never really looked back. Nobody could tell us how many waves of this there were going to be. Fortunately, that was really the last major wave. The economy reopened. Businesses were not able to keep up with the demand, and you saw domestic prices increase quite rapidly.
So just in that line, former Liberal Finance Minister John Manley recently was on record saying that the Prime Minister's fiscal policy is fueling inflation rather than resist it. Would you agree that continued government spending at its current rate is working contrary to the Bank of Canada's attempts to address inflation?
Look, governments, parliamentarians, you have difficult decisions to take. Governments have many priorities. We take government spending as given. So when parliaments pass fiscal plans, we build those into our projections. So those are built into the projection we have. We have inflation coming down to around 3% in the middle of this year. What I will say is that we are acutely aware that high inflation is hurting Canadians, and unfortunately, high inflation affects the more vulnerable members of society.
Absolutely.
They have smaller buffers. Much more of their spending is on necessities. They don't have the ability to cut back.
Absolutely, and we know that as well. But would you say that if spending over the last few years was lower, by the government and the fiscal policies, would interest rates not have had to be raised to today's levels?
Same kind of thing.
You can do these counterfactuals. Obviously, the more government spending there is, and it depends what the government spending is on, but if it's government spending that's adding
like he's
directly
trying to trap
demand, yes,
like,
other
that's
things
what it feels
equal,
like.
you'll get more growth, and in an overheated economy, that will put more upward pressure on prices.
And if the Liberal government continues to spend the way that they are, going through even their own projections, will interest rates have to go up in your estimation?
Well, certainly if demand in the economy continues to run ahead of supply in the economy and inflation does not come down in line with our projection, we've been very clear that yes, monetary policy would likely need to be more restrictive. In other words, yes, we'd have to raise interest rates further to get.
Is there a risk at current levels that's what you'll have to do?
There are certainly risks there's certainly upside risk to our forecast. And if those materialize,
are you afraid that it's because of the government spending going up?
Thank you, MP Hallen. That's the time.
It's like I don't think that he really is looking for like an answer. Like, yeah, I've already done the rant. You guys know what I'm about to say. But I don't think that all Conservatives on this board ask questions like that. There's a lot of good questioning here, and that's one that I want to get to here, because like there is value in the questions that the Liberals ask of the Bank of Canada governor here. But most of the time, it's kind of similar in saying, look how good we're doing, look how good we're doing. All of these economic measures are looking good. But not any questions about things that people are concerned about, right? They can sort of they try to make it sound as rosy as possible, which makes sense, right? But I want to flip here to some call-outs of Tiff Macklem, where some of the Conservatives call out Tiff on his past forward guidance, where he said that interest rates were going to be low for a very long time. I have a note here that is around 1140. So let's drop in here. And this is interesting, right? Because this is the term that people use: forward guidance. The Bank of Canada has only a couple tools, or I think we could probably break it down to 3 tools. Their 3 tools are interest rates, changing what the overnight rate is, so people can lend and borrow for either higher or lower interest rates, of course. The second one, quantitative easing and quantitative tightening. I'm not going to go down the rabbit hole on explaining that, but money printer goes burr versus eliminating money from the system. And the third one is their forward guidance, the language they use to try to get Canadians to act in a certain way. And this point here, I think, gets more into that, at least briefly here. Once we buffer. Connection problem. Okay, what are we at? We're at, what was that? That was 1140. We're gonna hit the good old refresh here. Hello. And to 1140. What is happening? How can I have a connection problem when we're all live here together? Oh my God. One more time for good measure. We're going to play it from the start. Come on. You can do it. F's in chat for this video player right now. Come on, buddy. Yeah, Ralph, I like the F. Okay, well, while that's loading, I want to go to this and okay.
Wow.
Oh,
hey,
okay.
yeah,
You can hear it. You can hear it. We're
call
back.
This,
We're back.
This meeting to order, and members just.
If
Here we go.
government spending contributes more than we've built in, more on aggregate demand,
Which it did.
at a time when we're trying to cool demand to bring it in line with supply, yes, that would be a concern.
So in July 2020, you told Canadians, quote, if you've got a mortgage or if you're considering making a major purchase or you're a business and you're considering making an investment, you can be confident rates will be low for a long time. Interest rates are now at 4.5, 18 times higher than the 0.25 rate in February last year. You've also admitted your previous statements that there would be deflation instead of inflation and that inflation would be transitory were a mistake. Given this record, what assurances can you give Canadians that efforts you and the bank are taking today will work and not make Canadians' finances worse?
A fair question, right? And I think one that Tiff doesn't want to be asked, right? Because his credibility, he's calling his credibility into question, saying, why should we trust you in saying that you're going to get rates down to 3% by the summer of this year and to 2% by halfway through next year, when you just said inflation was transitory in general and underestimated what you needed to do to get the economy back into a sort of balanced state, right? Let's hear his response.
MP Hallen, we are at the time. Governor, I'll give you 15 seconds, but we got to be pretty strict to get through this round. Yeah.
I think the assurance I can give to Canadians is we have acted forcefully. As soon as we saw the momentum in the economy really picking up and inflation rising, we've raised rates forcefully. It's starting to work, and Canadians can be confident that Canadians expect us to get inflation back to 2%, and we're determined to do just that.
Thank you. And now we're over to the Liberals. MP Sorbara, welcome to the committee, MP.
Thank you, Chair, and welcome, Governor and Deputy Governor. Governor, we've in your introductory remarks, you spoke about the imbalance between aggregate supply and aggregate demand. On the aggregate supply things, there are things that the policymakers can and should do. Productivity gains in an economy, putting in place policies, increasing the supply of inputs, one of them being labor. Can you indicate, and I read through the monetary policy report, the impact of policies that are happening on the aggregate supply picture in Canada with regards to labor, namely the implementation of a number of policies, including daycare and the Canada Child Benefit?
Yep.
That's interesting. He kind of lumps in a bunch of different questions there, but he's saying that the government, like the Liberal government, is currently doing things to help with the supply problem, right? We have high demand. We don't have enough goods and services to service that demand, right? No pun intended with giving us, like, service the demand for services. No pun intended there. But the question here is, like, is the Liberal government's policy doing a good thing for the economy here by, one, immigration is one thing that he pointed to, right? Bringing in more workers to satiate the demand, the labor market demand, right? Is this going to provide lower inflation, right? That's one thing, as well as the Canada Child Benefit and the $10 daycare goal that the federal government has with many of the provinces. The idea is that this will add more people to the workforce. Women will be able to work if they have lower health care or lower child care costs, as well as like the Canada Child Benefit helping with that, right? As well as the immigration point that we talked on. Let's hear what he thinks about the government's current policies to help with supply.
I'm going to bring the Senior Deputy Governor and ask her to take this question.
Carolyn Rogers, tag in.
So, what we have seen in the labor numbers is some really positive indications that more women, the participation rate of women in the labor force has increased. We think that should be, it's likely attributable at least in part to improved childcare. We know that is a barrier to women's participation in labor force. It's also probably the case that the more flexible work environment that's coming from 2 and a bit years of hybrid work is also contributing to women's participation. So that policy has helped, as has immigration, helped to bring labor supply into the market.
Thank you. On a different tangent, in the monetary policy report, we look at the nominal neutral policy interest rate. And the last time the assessment was done was in April 2022, and the estimated range is around 2 to 3% currently. When will that reassessment occur? And any indications on whether that range is still within that 2 to 3% range?
So once a year, we reassess our assessment of the neutral interest rate. So our next monetary policy report in April, we will be reassessing what our best estimate of the neutral rate is. I think I would underline that whatever estimate we land on, there's quite a bit of uncertainty around exactly what the neutral interest rate is. It's not something we can observe directly, and the inflation targeting framework is designed to deal with those kinds of uncertainties. So if our estimate of the neutral rate was too low, that means that our inflation forecast would start to come in off what we think, and then we'd have to adjust to do that. But things like the neutral interest rate, they're not like a pandemic that just hits you. Like, this thing probably evolves pretty gradually. So
some talk there on the neutral interest rate. We'll see Carpe Diem here with a question. Do you think interest rates will go up next month despite what they said? They are struggling. Thanks for the question here and for joining in on the chat here. I love to see so many people engaged in conversation here. Do I think interest rates will go up next month? No, I don't. I believe, in this case, I believe the Bank of Canada. That they're going to pause and see how things play out, especially given inflation came down as of the numbers we got yesterday, right? And what we talked about at the beginning of the stream, that inflation beat expectations. We expected it to be at 6.1%. It was at 5.9%. Macklem can take a sigh of relief. Thank God my hand's not going to be forced to raise interest rate. It's at least at this next policy decision. If we have an abundance of data that comes back and says, well, jobs are still tight, inflation is ticking back up, then I think he's going to be like, oh shit, we got to raise rates again because we don't want this to go on longer than we need it to be. So that's interesting. Thank you for the question there. I want to flip to a question here on geopolitical pressures and what he thinks the major risk of any conflict with China or a prolonged conflict with Russia, what that could do to the Canadian economy. I believe Tiff Macklem asks or answers a question specifically about that here.
Which is really quite a game changer. This transformation seems to be accelerated by the war in Ukraine and the economic sanctions on Russia, which is displacing the movement of capital. On the international scene, then, the international financial system presents a rather large risk. What do you make of that? Well, yes, you're correct that there is a lot of uncertainty throughout the world. As for geopolitical pressures, particularly between the United States and China, it's quite clear that these are on the uptick. They continue to be more severe, but we're trying to reduce inflation at its source. And there are risks, of course. If there's a sudden incident of some sort which would disturb or disrupt the supply chains, we might have some serious problems. I was in BC earlier this year, and I said that over the last 15 to 20 years, the participation of China in the global economy and the repercussions on our supply chains has reduced the inflation rates, particularly for goods, for the trade in goods.
That's an interesting point being brought up here. And this is one that I talked about on a video on the channel, sort of presenting the thesis that perhaps we've entered an era where inflation is just going to be higher. Right? We over the past 20 years, we've seen the emergence of China as a developed economy that we can trade with, and also sort of defer our labor costs to. Right? That's like we've seen. That's why we've seen technology and other goods go down in value, or down in price. When you think about buying a 50-inch TV 15 years ago versus buying a 50-inch TV today, of course that price is actually cheaper. Right? People were buying that for like $2,000 10, 15 years ago. Now you can buy one for $500, right? That's a disinflationary pressure or a deflationary pressure that was the result of cheaper labor, more just-in-time supply chains, right? And now that we have this sort of hesitancy to have more fragile supply chains and potentially trade with partners that are less stable on the geopolitical front, well, maybe we just, and with reshoring and friendshoring, these concepts, perhaps we're going to have to pay higher labor costs. Perhaps we're going to see more inflationary pressure as a result of this reshoring of labor and lack of ability to sort of trade with these lower labor cost industries or countries, rather.
In future, it's quite likely this won't continue at this pace. It might actually reverse. The trend might reverse. It's possible that there'll be more pressure on production of goods that require a longer time to provide. And we have to take into consideration this as a factor when we try to target our inflation forecasts. Perhaps we should simply raise what our target inflation rate should be in a certain sense. When
Okay, so now I want to hop to a section that is in the title of this live stream. I want to get to the question of the bank's negative income right now, right? Well, because of the relationship between the bonds they're holding and the interest rates they're paying on settlement balances, the sort of balances that big banks have at the Bank of Canada. Right now, the Bank of Canada is paying out more interest than they're making on the bonds that they're holding, and as a result, for the first time in their history, are actually losing money. Now, Chrystia Freeland has talked about allowing them to sort of defer this debt and pay it back when we're back in normal times where the bank typically makes around $1 billion a year. Of course, Tiff Macklem saying we don't optimize our operations for profit, but saying in the future it's projected that they will be back in the green or in the black, I guess you call it, and they'll be able to pay off that debt. Flipping to the comments here at 2:05. Let's flip forward here. And I see a question here from Sebastian. Do you think the government will need to step in and bail out Canadians who took on mortgages at the peak and now cannot cover monthly payments due to the increase in rates? Do I think they will need to? And do I think that they will? I think are different questions. I think that there's a lot of people out there in the housing market that are under significant stress right now, but because of the way that Canadians feel about housing and the sort of the way that they think about it, I think that that's the last domino that will really fall, right? We're not seeing these people who bought at the peak panic sell right now, right, because they're underwater on their mortgages. They're cutting costs in other areas to pay the mortgages, and maybe their quality of life is suffering as a result. So I think that Canadians are going to continue to pay their mortgages up until the very last moment where they can't any longer. And hopefully the idea here is that at that point, perhaps we'll be at a more normal interest rate, normal for the past 15 years, past 10 years, right? And perhaps those people who bought at the peak might get back and so that they're not underwater anymore. But now onto the Bank of Canada and their sort of losing money situation that they're in right now for the first time.
We have and if we stick to time, and the Conservatives starting off with MP Morenz.
Governor, I wanted to follow up with you on a series of articles that have been written by Mark Rendell at the Globe and Mail, which I'm sure you're familiar with, where he talks about the fact that traditionally the bank has contributed its earnings to the federal treasury on an annual basis by remitting an amount. Most recently, over the last number of years, it's been about $1 billion a year. Now you've got this odd situation now where you've got billions of dollars sitting in the settlement accounts that you're now paying your overnight rate 4.5% to the banks that were only earning 1% on the bonds you purchased from them before. So essentially the bank for the first time in its history is now in a loss position. Since we last spoke, you've now gone and made an arrangement with the Minister of Finance that she's going to allow you to keep your retained earnings. I guess my question is, would you agree that essentially this arrangement amounts to Canadian taxpayers bailing out the Bank of Canada because of its quantitative easing program?
I'm going to say a couple of things. I'm going to ask the Senior Deputy Governor to expand. This is a very important question. The first thing I want to highlight is that the Bank of Canada does not run monetary policy with a profit motive, and whether we make gains or losses has no implications for the operations of the Bank of Canada or for pursuit of our monetary policy or financial stability goals. The second point, as you indicated, is that the Minister of Finance has indicated to us that we can basically retain future gains to offset the losses. Every major central bank has engaged with QE. We're all faced with a similar situation. In fact, Canada's balance sheet as a proportion of GDP is smaller than most. This is a good solution, and I'm going to ask the Senior Deputy Governor to say a few words about.
Yeah, so Tiff's answer here to, well, like if you are losing money as a Bank of Canada are you asking the taxpayers to sort of bail you out here because you're in a position where you're losing money? And my personal take on this is that no, this isn't something that the taxpayers are necessarily specifically bailing out, especially when you consider the position that the Bank of Canada has been over the long term, where typically it's a number in the billions of dollars that the Bank of Canada, as a result of the interest that they earn on their holdings, typically they make a lot of money and they remit that back to the Canadian government, which helps them run less of a deficit. And they've been doing this for years and years and years. And now we have the one situation where the balance sheet works in the opposite way because they did do quantitative easing and all the mass purchase of Government of Canada bonds. That's what got them into this mess. So perhaps that was an error. But I think when you take into consideration the fact that the Bank of Canada typically has been giving all of this surplus to the Government of Canada each and every year, that allowing them to sort of defer this, and instead of giving the money back to the Government of Canada, sort of just paying off their own negative balance sheet, I think that it is a reasonable solution. I might be wrong here. I wonder what your take is on it. But let's hear from Carolyn Rogers.
Just the mechanics of it and respond directly to your question.
Yeah, so the cash flow or the mechanics of how this will work is, as you described, it's an odd situation. It's also a temporary situation. So in normal operations in a normal year, the bank would return about $1 billion to government or to taxpayers, as you've described it, for a brief period of time until we run off the settlement balances. We expect we're already down about half, so we expect that'll continue to go down. But for that brief period of time, we will run a loss, and we won't be returning that normal dividend to taxpayers.
How much longer? I only have a limited amount of time, I apologize.
Go ahead.
But how much longer do you think it'll take to reduce those balances in the settlement accounts?
Well,
to the point that
we're about at half of where we were at peak, so it depends to a certain degree on the path of interest rates. But
okay, thank you.
Okay, so some interesting comments. I want to skip forward here. I want to bring you the highlights on this stream. I know we're getting to an hour here on stream. So let's flip forward to some comments on amnesty, specifically folks who are extremely low income, who applied for things like the CERB and the CRB, who weren't qualified for it. Right now, the NDP are calling for amnesty so folks don't have to pay this back, because it's like getting money from, or getting blood from a stone, right? You can't get money from folks that don't have it. And especially important to bring into the context of this is the Canada Emergency Wage Subsidy, which the CRA recently said, hey, it wouldn't be worth it to go after the $15 billion potentially in fraudulent sort of money that was given out there, while the government is still sort of hounding, and the CRA is still hounding low-income individuals over a couple $1,000s, right? This is a little bit questionable in some people's eyes, and I believe we get some comments on this around 218. Let's hop forward.
There's on our banknotes. There's no reason. There's no legal reason why we can't continue to have the ones we have with the image of the Queen. Thank you.
Now over to MP Blakey for 2.5 minutes.
Thank you very much. So if the government were to provide a debt amnesty to low-income Canadians who owe for having been ineligible for CERB payments that they received, would the bank interpret that as a fiscal measure contributing to aggregate demand, or neutral with respect to aggregate demand?
We have not analyzed that, so I really can't give you an answer. I mean, if that happens, we will analyze it and we'll build in. But I don't know in front of me what the magnitude of that is. So
In what way?
I can't answer the question. It's not something we've analyzed.
Given that the money's been spent, and these are folks that don't have money available to repay, in what way could it contribute to aggregate demand?
Well, I don't know. I haven't analyzed it. I'm not going to give you an answer on something I haven't analyzed.
So this is another one of the areas that, like, it feels a little bit like the NDP is trying to get an answer from the governor of the Bank of Canada so he can say, hey, we should go forward with this amnesty route, forgive people for their debts if they weren't eligible for the CERB payments here. Tiff Macklem doesn't give them anything at all to sort of bring back here. But the idea that Daniel Blakey, who is one of my politicians that I admire. Each party has different politicians that I admire, regardless of what their views are. I admire the way that they conduct the business, and Daniel Blakey is one of those. He's talking here about saying, like, okay, the worry is that if we forgive this debt, is that going to add more demand and be inflationary? And he's trying to make the point here that it wouldn't be inflationary to forgive people for this debt that they have to the CRA because they were ineligible for CERB payments, because this money has already been spent. It's sort of just like subtracting from future potential spending from the lowest income folks. So he's saying that, like, I think that would have a negative impact on inflation, but not to a large extent. But Macklem doesn't give him shit all here. Like he's not giving him any help. So I found that rather interesting.
Earlier, you said that the one-time impact of eliminating the carbon tax would be a 0.5% reduction in inflation. Is that a net amount, or do you think that it's possible that eliminating the carbon tax all in one go could also have an upward effect on aggregate demand?
So that is just purely an arithmetic calculation. So it's what economists would call everything else equal. The arithmetic impact would be, so inflation 6.3% now. It would be 5.8 if you eliminated the carbon tax tomorrow.
Okay, and that's
to the extent
without
that has other effects on the economy.
Okay.
Then yes, that would have a second round effect, and you'd have to take that into account.
So the maximum
we haven't done an analysis of that.
Yeah. Fair enough.
So I don't know the
But
answer.
if you allowed for the effect of that elimination on aggregate demand, the 0.5% is a maximum possible benefit. It could be lower depending on how people spend the money that they would.
It would depend on what happened, yes.
Yeah. Okay. Thank you very much. And then
Tiff really doesn't like Blakey. He was more upset about that question than the fishing that it felt like Jasra was doing at the beginning there. So one more point that I want to touch on here before we wrap things up, and that is the expectations diminishment that makes it easier to reduce demand. Specifically, I believe this is about businesses and how easily they can raise their prices. Some important comments here from the Governor of the Bank of Canada.
Well, from a monetary point of view, if we want to normalize the behavior of market prices, is to resolve the issue of excess demand. When consumers forecast that the inflation is coming down, their attitude to the prices will come down. It's easier to bring prices down. But when the economy is better balanced between supply and demand, the competitive function works much better, and it's a lot more difficult for companies to raise prices because they'll lose market share. They'll lose their consumers. So it's very important that we do raise inflation, the interest rate for a while to diminish expectations and reduce demand.
Yeah, so that's the main argument here. Like the NDP are saying, well, we've talked about like wage prices being higher and how that could impact demand and how that could be inflationary. But how come you're not talking about businesses who raise prices? And to that, Tiff Macklem is saying, well, actually, we are talking about that. We're saying that when there is so much demand in the economy, businesses can pass on expenses without fear of losing those customers because there's so much demand that even if some of them go to their competitor, they're not going to be able to fulfill the total demand. So he's saying we need to make it so that the supply-demand balance is back where it should be. In other words, make Canadians feel more poor or provide more supply to satiate that demand, so that like we get back to a balance so that businesses can't pass on those expenses as easily. That's what the Bank of Canada is hoping happens, that with their raised interest rates, everyone feels more poor, people spend less, and that's the sort of run-on effect that happens. So those are some of the key highlights from this hearing. We're going to keep on following this story as we go, but I thought that was interesting. I wanted to bring it to you here and talk about it with you on the live stream. I love these live streams because I get to chat with you more directly one-on-one. I feel like you get a little bit more of an unfiltered version of my thoughts and the things that I talk about here on the channel. So I appreciate you tuning in. If anyone has any final questions before we wrap up the stream here for the night, you can message me specifically by going at Russell Matthews in the chat, and it'll sort of show up on my side as a little bit more highlighted, so I can see things. And by the way, if you haven't already, like the video, it'll help this the live stream, but also the video that sort of gets played after the live stream where people can come back, help more people find that. So I appreciate you subscribing and liking and telling all your friends. I appreciate that and helping the channel grow. Yeah, thanks so much for tuning in, Aaron. It's good to see you in here. Good to see you in here. I think we got good turnouts here. And let me know what you think of the format as well. Do you like these live streams where I go over a bunch of different videos, give my takes on different things? And what do you think of the idea of sort of chopping up these live streams to make the main channel videos? Do you think that that's effective, or do you think that I need the detail and I need the polish on those main channel videos? I like talking about YouTube as well. That's one thing that I like sort of thinking about. What's the best way to do things, especially optimally in terms of time, because I'm running another business here and I'm working for another business as well as doing the YouTube channel. So I'm always trying to keep things efficient on these. Yeah, thanks so much for the kind words, Anna and Clone and Gilbert. Amazing. Beautiful. Well, thanks so much for tuning in, everybody. We've got one more question here from Sheridan. Where do you see inflation heading? And thank you for providing us the information. I think over the short term, we're actually going to see it go down. Obviously, no guarantees. This isn't financial advice, all that yada yada, all of the disclaimers, of course, is just my opinion. I think that it's going to come down in the short term. I don't think that rates are going to come down for a while, but I do think that inflation is going to come down in the short term, especially because we're now comparing to these new higher prices, right? I don't think the rate that people will keep increasing their prices can sustain at the rate that it has, going all the way up to 7-8% like we saw at the peak there, right? So we're comparing to these new higher prices, and when you think of base year effects, it's like when we get our inflation number, like say we're looking at the December inflation number for 2022, we're comparing that to the where the prices were at a full year prior, right? So as we get later into this year and we're starting to compare against the peak pricing, I think that the rate of inflation, that will help it come down as well. So that's something that I think the folks may not consider, is like the actual base year effect. And that's actually why the Bank of Canada thought inflation was going to be transitory in the first place. They said, hey, the only reason we're seeing inflation here, this was back in 2021, I believe, or early 2022, when they started seeing inflation really start to pick up. They said it's just transitory because it's energy prices, it's the war in Ukraine, but also it's base year effects. We're comparing to when we were actually for a very short period in a deflationary environment at the very beginning of the pandemic. They said because we're comparing to that, that's the only reason we're seeing the uptick in inflation. They were wrong, of course, but that's sort of the flip side that we could see here, is the base year effect from higher inflation last year. Yeah, so interesting stuff. Thanks so much for tuning in, everyone. I'm gonna hop off here and grab a late dinner. It's 7:40 and I haven't eaten yet. My mom would be upset with me for not taking care of myself. So I'm gonna go grab a bite. Thanks so much for tuning in, everyone. Thanks for liking and subscribing and supporting the channel, and I'll see you all next time. Have a great night. Peace, everyone.